Performance has, of course, been impacted by the decline in China, where MSCI China is down almost 50% in the last 3 years. But, the same China market has also given us a lot of good returns in the past. So we will see these ups and downs in the short term. I think the important thing for us is to have a portfolio that's resilient and which we believe will bounce back when the markets recover. And then have sufficient diversification so that if there's a problem in one area, that drag can be sort of offset partly by our exposure in other areas. And that's how we look to sort of balance our portfolio in that sense.
When we look at the net portfolio value in Singapore dollars, slight uptick, 382 last year and then 389. So you were talking about obviously the issues in terms of the losses from the China market. So how has that been able to, I guess, been offset?
So therefore, it has, we've had good returns in markets like the US and India. It has offset that and therefore had lower returns for the 1 year period. But the point I was making is that as a resilient portfolio, we would expect the companies we have in China to sort of bounce back when markets recover there. And in the meantime, we've at least been able to have balance in the portfolio in the 1 year period and maintain our 10-year returns of around the 6 to 7% returns, 10 to 20-year returns, in spite of the drag we've had in the last 3 years, not just 1 year. But again, we've tried to construct a portfolio that, given where we are right now, we feel pretty comfortable about the path forward, about the strength of our portfolio companies, and how they could benefit from any recovery that we see going forward.
When we look at exposure by countries, I see that China has declined slightly. What is the China strategy going forward? I think it's been described as being cautious, but are you looking at more investment opportunities there?
Yeah, it's cautious because of the environment, but we continue to see significant opportunities. So a lot of the work has been in terms of reshaping our portfolio in China to areas that we think will be the beneficiaries in the world that we see going forward. So, for example, we clearly would try and avoid investments in areas that are in the crosshair of US-China tensions. We'd ideally like to avoid companies that are impacted by domestic regulation significantly. But there are a lot of other areas which are neither in these buckets. A lot of them focus on the domestic market. So, for example, consumer, whether it's cosmetics, whether it's beverages, whether it is consumer durables. There's a lot of focus in China now from the consumer on value for money, which means the domestic brands are gaining share from international brands. That's one area of focus. You have import substitutions in industrials and auto components and other areas where a lot of Chinese companies are coming up and competing with multinationals very well. We're focused out there. Biotech, which on the innovative side, you're seeing a lot of innovative drugs being developed in China. So out-licensing from China to Western companies has gone up 3x in the last 3 years. And this year alone, 4 companies over $1 billion have been acquired by Western multinationals, Chinese companies focused on biotech. So there are opportunities which we continue to see. And our focus really is on shaping our portfolio so more aligned with these areas, which are less exposed to geopolitical shocks or domestic policy, but where we see some secular trends.